Major funding for Carolina Business Review is provided by Grant Thornton, an international accounting, tax, and business advisory organization dedicated to serving middle-market companies. Grant Thornton, a passion for the business of accounting. Novant Health, including Presbyterian in Charlotte and Forsyth in Winston-Salem, are affiliate heart hospitals of the Cleveland Clinic, consistently ranked #1 in the nation for heart care. Blue Cross and Blue Shield of South Carolina, proudly serving South Carolinians since 1946. And by Sunoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services with more than 300 operations in 35 countries.
The American economy feels like it's on a teeter-totter. One week, great news, the next bad, as we attempt to recover from the Great Recession. One industry that's become a four-letter word, bank. The financial industry took much of the blame for the recession and is still being blamed for the slow growth back. Welcome to Carolina Business Review, the longest running and most widely watched source for Carolina business and public policy. I'm Sean Flynn in for Chris William. Today, we talk dollars and cents. We'll take a look at banking regulations and what it means for banks. We'll take a closer look at community banks and if days are numbered for small banks. And later, we'll be joined by John Windley, president of South Carolina Bank and Trust, and how his small community bank is becoming a regional powerhouse.
Major funding also by the Duke Endowment, a private foundation in Charlotte enriching communities in the Carolinas through higher education, healthcare, rural churches, and children's services. And by Blue Cross and Blue Shield of North Carolina. Who's responsible for rising healthcare costs? Join Blue Cross and Blue Shield of North Carolina and many others in a candid discussion at letstalkcost.com. This edition of Carolina Business Review was recorded June 29, 2012. On this week's program, Dr. Tony Plath of the University of North Carolina at Charlotte, Frank Rainwater of the South Carolina Board of Economic Advisors, and special guest John Windley, president of South Carolina Bank and Trust.
All right, welcome to the show. Thank you both for being here, Tony, Frank. We're going to talk a lot about banking regulations on the show, but we'd be remiss not to start off with the hot topic right now. The Supreme Court just made its landmark ruling on the Affordable Care Act. Frank, let's start with you. What is your initial take on this, and I guess what does it mean for the future of the economy?
Well, I think that's what a lot of businesses are just now going to decide. As the suit was making its way through the process, I think a lot of people may have put off hiring decisions, waiting to see what the outcome of this decision was going to be. Now that we have some finality to it, we're going to see what impact, how business is going to comply with it. So we're kind of closely watching to see what maybe hiring practices may change or come up with in the next several months.
Dr. Plath, I won't go into a lot of the details with you on this, but a lot of the big banks, obviously, this means a lot of money, dollars and cents for them. Do you think this cuts into their bottom line eventually if this is the way it ends up?
Yeah, it looks like we're moving toward a single-payer system. So as we move in that direction and we add about 30 million people to the healthcare rolls, the cost of healthcare is bound to go up. Plus, you know, with no longer having a waiver on pre-existing conditions, that's going to raise the cost of health insurance as well. So I think over the next few years, if it holds and we don't overturn it at the ballot box in November, then in fact the cost of healthcare is going to rise for all of the businesses that currently have plans. It'll be interesting to see if they maintain their plans or if they go to the risk-based pools at the state level. For now, they're saying they're going to maintain insurance as a corporate benefit, but it'll be interesting to see how long that lasts if Obamacare really is fully implemented in 2014. I don't think it'll be the case.
Well, I'm sure there'll be several other CBRs just dealing with that issue. Let's get back to the economy. Frank, economists are all over the map right now when it comes to predictions right now with the economy. Where do you stand on it right now, specifically here in the Carolinas?
Well, specifically in South Carolina, we're doing pretty well. We had several years of downturn. We had 24 months of negative employment growth year over year, and now we've had a period of 24 months of positive growth year over year. Granted, it is not as fast as it was prior to the recession, but we are seeing sustainable growth out there in the 1% range in employment. Our income is growing around the 4 and 4.5%. Not great compared to the 8% we saw in the decade of the 2000s, but it is growth, and it's good growth.
I think that right now we'll take growth, period.
Period, yes.
Tony, what does it mean for the banks right now? What do you see? I mean, again, we hear news, good news, bad news. I guess where's the economy right now with the banks, especially the big banks?
It's a mixed picture for banks, but at the end of the day, I think the most problematic feature of the economy is the slow rate of growth that we're having, the overhanging inventory of foreclosed properties, and the fact that the labor market is not recovering at a sufficiently rapid pace. So what that does is it limits the opportunities for growth in banks. Although, you know, some of the banks are doing pretty well as far as loan growth is concerned. Wells Fargo's posting really good numbers. Bank of America's not. So it's a mixed picture, but if anything, the slow rate of growth in the overall economy slows down the rate at which banks are recovering because they just can't grow their loan portfolios that quickly. There isn't that much loan demand out there.
And that's what I want to talk to you about, Frank. When it comes to loans and loan demand, how critical are the banks in trying to restart this economic engine that we've been sitting on?
Well, certainly they're an important part of the economy. People don't have the assets in their accounts, simply go buy their homes. Small businesses are going to need them for the capital they need. We're looking to see, you know, with these new regulations, how that's going to impact is it the bottom line, or is it going to take away resources banks are going to have for the economy? And
is that what you think the holdup is? Is that the banks aren't loaning, or is it there's too much regulations? We're going to talk more about that, but what do you think it is?
It's almost the chicken and the egg. Do you need good growth in the economy and employers hiring to have workers out there to go to the banks, or do you need the banks to have the capital to help stimulate small businesses?
Well, Tony, are banks making those loans? We keep hearing all these people saying banks aren't making loans, that's why it's stalling the economy. But when we talk to the bankers, they're saying we're making the loans.
Oh, no, there's plenty of liquidity. The banks are well capitalized. The credit issues are behind us. So, you know, the banks stand ready to lend. The real problem in the lending market is finding well-qualified borrowers. And so the companies that are in a position where they're able to borrow are reticent to do so because they're not certain the economy is going to continue to grow, and the loan demand that's in the market, the people that do want to borrow money just aren't that well qualified for credit. So, you know, as Frank said a minute ago, it's a chicken and the egg phenomenon. What we really need to see the banking industry stabilize and begin to grow is a recovery in the labor market. Once people get back to work and are confident that they have a job, they'll start spending. Once they start spending, they'll start borrowing again, and the banks will start to grow.
Well, it seems like we keep having this pattern where our consumer confidence starts increasing, and then something happens, whether it's Europe or something happens where that goes away.
In the spring, it was gas prices. Lately, it's been Spain. Before that, it was Greece. So, you know, the rate of growth in the overall economy is so slow that almost anything can upset the apple cart right now. So, higher oil prices will cause us to slide back into a recession. Then the crisis in Europe and the banking issues in Europe could cause us to slide back into a recession again. What we need is sustainable growth that's in excess of about 2–2.5%. And right now, we're just not seeing that in the American economy.
And after that, you're going to have the federal budget deficit situation
and the tax increase that takes effect in January.
You know, cutting government spending or raising taxes is going to be a drag on the economy.
You guys are depressing me. Frank, what do you see as the path to getting us back onto a good economic recovery?
Well, I agree with Tony, and it's going to be job growth. What we have seen in the numbers that small businesses have continued to hire, and that's been a major source of, or one of the leading sources of employment growth in there. We're starting to see more broad-based growth in all the sectors except for the construction and in the financial industry.
Correct.
Especially. Those employments have not gone. I think more maybe this is about perception. Or relative. Everything in the 2000s was going great, and they were growing at a very good rate. Now we're in a slow growth period. So I think, you know, look at consumer confidence, it may be about more expectations. Maybe they're thinking of that great time in the 2000s when things were going gangbusters, and now we're just in a little bit slower growth period.
Tony, the perception of the banks is not good right now. It's probably right up there with attorneys and journalists. You know,
speak for yourself.
Especially when the president is calling a lot of these bankers fat cat bankers. I mean, obviously, do you think the perception of banks and bankers is changing, or is it still kind of down?
If you look at the reputational capital of banks, especially the big banks, there's a lot of public anger out there. and it's particularly directed at the banks that are doing a lot of the foreclosures, and like Bank of America, that we're responsible for, or at least perceived to be responsible for, a lot of the problems that we see in the mortgage market. So, the banks do have a lot of damage control and a lot of reputational repair that they need to do to sort of fix their public perception. But having said that, remember, other companies have been perceived badly by the public as well. We could talk about Exxon, we could talk about BP, we could talk about Johnson & Johnson back in the Tylenol scare. Those companies all came back, and the banks will too. It's just going to take time, and they're going to have to work at repairing the damage.
Well, I know we could talk to both of you gentlemen for the full half hour, but we're going to keep you on the panel so you can be the journalist and to help ask questions. But many say banking is now all about politics, and politics is what we'll be talking about next week. On the next CBR, we'll be joined by 4 mayors across the Carolinas. Mayor Terry Bellamy from Asheville, Mayor Steve Benjamin from Columbia, Mayor Robbie Perkins from Greensboro, and Mayor Stephen Wukila from Florence. We'll go in depth on the issues facing their cities and why it now seems they're competing against each other rather than trying to work together. That will be on the next CBR. Now, some call the Frank-Dodd Act a small bank killer. We're seeing more and more of these community banks go under or be sold. One bank seeing some of the benefits is South Carolina Bank and Trust. Joining us now, President of SCBT, John Windley. John, thanks for joining us, first of all. But
thank you.
How are things going right now? You just heard us talking about the perception of banks. How are things at SCBT?
Things are going pretty well for our company. We've been fortunate through this to be able to continue to grow our company and to maintain, a level of strength throughout the entire downturn. One of the positive things about our company is that, we've been able to, like I say, maintain the growth, continue to pay our full dividend throughout the cycle, and growth has come. Although it's slow, it has been very, very good for us as we've come through this cycle.
Well, I know in just the past couple of years you've managed to acquire or merge with 4 different banks. Can you talk a little bit about that strategy and how you basically almost doubled the size of SCBT?
Well, as things change within the industry, the opportunities have been really twofold. There's been opportunities for us as banks have gotten into trouble through FDIC-assisted transactions, and we've been able to move out of South Carolina and into Northeast Georgia through 2 acquisitions that were assisted by the FDIC in acquiring 2 institutions over there that were over 100 years old. And so that's been, beneficial for us from a market expansion standpoint. And then also there's been opportunities for us with the smaller community banks on the M&A side to do what we call traditional M&A activity. And that's acquiring healthy smaller banks, that are looking for different reasons, are looking for a strategy, to exit or to become a part of a larger organization.
All right, Tony?
John, you really kicked it in the first quarter. If you look at your numbers, profitability is way up, credit quality, your charge-off numbers look like it's 2006 again. How are you doing it? What's your secret?
Well, Tony, I don't think there's any real secret to it. We throughout the cycle we have maintained a level of quality within our loan portfolio. We've been challenged through all of this, and as we work through our problem credits, things have improved. Our business model is such that, a lot of folks are looking for a community bank and the opportunity to have relationships with individuals that are deeply involved in their communities. And we've seen, significant growth in some of our markets throughout the franchise by folks that are moving away from other institutions and are moving to us for the community bank experience and that level of service.
How's your loan book changing? Are you moving away from commercial real estate, moving into, commercial and industrial lending?
Tony, a couple of things there. If you look at our book over the last few years, we have minimized our efforts in commercial real estate. A lot of the problems that were created throughout the Southeast were, the aggressive lending that was being done in the real estate sector. And so Construction and land development, we've shrunk our book of business in construction and land development and commercial non-owner occupied. And what's been the real catalyst for us there's been an uptick in consumer lending. Consumer real estate is up. Commercial owner-occupied facilities, we financed a number of those across the Carolinas and Georgia over the last couple of years. And we're seeing a little bit of improvement on the C&I side. A lot of banks are looking to diversify their portfolios and to grow their C&I business, so it's highly competitive out there, but we are looking for opportunities on the C&I side as well.
Okay.
Frank?
If the economy gets going, do you see the Carolinas, North and South Carolina, being in a better position, prepared to help businesses, small businesses, industrial users to get going?
Frank, I really do. And y'all talked a little bit about it earlier on the show. There's a tremendous amount of excess liquidity out there in the banking industry right now, and the banks are anxious to deploy that excess liquidity and make loans. And the challenge has been, a lot are finding qualified borrowers and folks that are looking for opportunities. A lot of the businesses right now are taking a little bit of a wait and see about, what's going to happen with the election, what is before they pull the trigger and make those additional capital investments. As you visit with commercial and industrial companies, a lot of them are sitting on significant amounts of liquidity, but they're reserved and they're just not. They want to see what's going to happen, and like I think Tony said, see some improvement in the overall hiring and economic activity in order for them to turn that money loose and begin to expand and begin to hire folks. So there's a good bit of uncertainty that's out there in the market right now, which I think is holding back folks from making those investments.
So you need the growing economy and employers and employees to have more qualified bankers, lending
opportunities. Yeah.
John, let's talk regulation. Frank Dodd. I've heard that unless a bank has at least $1 billion in assets, it's basically going to have to go under. Talk about what these regulations mean for you and how SCBT is handling it.
Well, the biggest thing right now, Sean, with the regulation is I think the lack of clarity. The Dodd-Frank, you can read different things, is 4,000 or 5,000 pages of regulations or the definitions of regulations. And some of those regulations have been finalized and put in place, but there's over a couple of hundred that have not been written yet. So it's very disconcerting and to not know which way things are going to go with certain parts of your business and have clarity around the regulatory environment. And so that right there is a significant challenge for us. When you start looking at the smaller organizations or the smaller banks, I'll give you an example. At SCBT, and a lot has been written and said about change in mortgage regulation, and we have a very active mortgage department and have done very well for a number of years. And we've had to add 3 headcount to that department just to track and work with new government regulations that really, in our opinion, don't have a significant impact on improving the level of service or making it safer for mortgages and that type activity. And so that's just, that you could take that example and spread it across a number of different areas within our business model, and you're going to see that it's going to require additional resources to manage government regulation, which is going to take away, opportunities to be out on the front line and to visiting with businesses and making those small business loans and things that are going to get the economy going. So it's a challenge for us.
I've actually heard that from other bank CEOs saying that this is not really about making the industry safer. It's just mostly congressional overreaction to what happened.
Yes.
Would you agree with that?
I would.
Tony?
John, can you talk for a minute about the sort of relationship you have with your regulators. Some banks are saying that, you know, the FDIC, the OCC are becoming a little kinder and gentler. Other banks aren't. Other banks are saying there's still a lot of pressure from the regulators to tighten credit quality, and the examinations are really tough and tight-fisted from the regulators. How are you seeing relationships with your regulators?
We've always had a very solid relationship with our regulators. And you know what we as a company have always asked for is a fair but tough exam is what we look for from our regulators.
Feel like you're getting it?
We feel like we're getting it. Yeah, we do. You know, there is a lot more discussion around credit, you know, than probably perhaps in previous examinations. But you know, we feel like the regulatory group has been reasonable in the conversations that we've had about specific credits and so forth. So, you know, we feel like that's very important for an institution to remain, you know, sound, and so it's something that for 78 odd years that we've been around, we've always valued the relationship that we have with the regulators.
Are they engaging your board in more extended discussions of credit quality than they used to?
Not so much the board, but they are extending conversations and going in more depth with management about individual credits and understanding individual credits. I think there's a lot of depth to understanding your loan portfolio and the credit book. They have also, you know, they look at concentrations and some of the activities like we talked about, construction, land development, and commercial real estate, and have encouraged us to work that level of book down and to focus on others. But we've been very fortunate to have a good relationship with the regulators that work with us.
Frank?
Hindsight's usually better than foresight. Given that we've had this regular Dodd-Frank adopted a couple of years ago, and now you're trying to implement it. You see changes in there. There are things that will come up in the banking industry in the next few years. We're going to say we wish we would have addressed, or maybe they went too far with Dodd-Frank, or any general areas like that you think they're going to have to come back and revisit?
You know, it's hard to say, Frank, with a lot of the rules not being written yet. You know, there's kind of an old adage in the banking industry when there's a pendulum there, you know, and when the pendulum slides too far to one side, the tendency is for when you let the pendulum go, it slides too far to this side. And banks like for it to be in the middle, you know, so they understand the rules and understand, you know, exactly what's expected. And I think what we're experiencing right now is that pendulum got too far over here, and now with the regulatory environment, it's too far over here. And I think it's just going to take time, and unfortunately, you know, along the way, because of, Sean, the question that you asked about, you know, banks, there's going to be community banks that are just not smaller community banks that are not going to be able to cope with the increased regulatory burden, and so they're going to look for, you know, an exit strategy, and so you're going to see continued, I think, consolidation within the banking industry, and I think you're going to see that consolidation accelerate for a number of reasons.
All this additional regulation has to affect your bottom line. We've heard a lot of big banks and some of the snafus that they've had trying to increase revenue. How do you address that issue? How does SCBT address the revenue question?
Sean, I think there's two things. You know, as a company, we've got to be more efficient, you know, and that's cost controls, expense saves, those type things. So, you know, that's one side of the equation, is being more focused on expense and expense saves and being more efficient with the way that you do business. The other side of that is looking for opportunities to grow, you know, your revenues. I mentioned mortgage earlier. You know, we have had very good success on the mortgage side, and with interest rates at historic lows, you know, we have seen, you know, an increase in our mortgage banking fees, which has been significant. One of the encouraging things that we've seen recently about that is the mix. There for a while it was mostly refinance business, but we are seeing an uptick in purchase money activity, which means folks are out there buying homes and looking, and so we think that's a very positive sign. The other thing that we've done as a company is expand our wealth management area, and we have done that in several markets. We've been able to go out and hire experienced wealth management bankers from around the franchise around our franchise, and they've had a meaningful impact on our non-interest income on the wealth side.
All right, and that is going to have to be the last word. We could talk for hours about this, but I want to thank all of you for coming on the show today. It was a great topic, and thank you all for watching.
Major funding for Carolina Business Review was provided by the Duke Endowment, a private foundation in Charlotte enriching communities in the Carolinas through higher education, healthcare, rural churches, and children's services. Blue Cross and Blue Shield of North Carolina, who's responsible for rising healthcare costs. Join Blue Cross and Blue Shield of North Carolina and many others in a candid discussion at letstalkcost.com. Grant Thornton, an international accounting, tax, and business advisory organization dedicated to serving middle-market companies. Grant Thornton, a passion for the business of accounting. Novant Health, including Presbyterian in Charlotte and Forsyth in Winston-Salem, are affiliate heart hospitals of the Cleveland Clinic, consistently ranked #1 in the nation for heart care. Blue Cross and Blue Shield of South Carolina, proudly serving South Carolinians since 1946. Sunoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services with more than 300 operations in 35 countries. And by viewers like you. Thank you. Promotional consideration provided by Business North Carolina Magazine. For more information, visit carolinabusinessreview.com.